we have a huge top. Exxon Mobil, energy sector, oil refining, and New York Stock Exchange. Breaking down, guys, right here. That target, if that closes below 73, I think I got an implied measure move. Here's the greedy one. All the way down to 52. Here is some support, guys, right here. So we might not get to here first shot. Might hit some support right here. Might overshoot with the wick, but after that get the month close above. But what I'm seeing now is if it does overshoot and the price action decides to come back above that monthly defined support at 56 and just play a little bit here, that is a monster top, guys. Paste arrow. And that gives me an implied measure move to $10. Ding, 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 ding. All right. Got some more support here. Natural support. Got also some got it here, some more support also. Previous resistance turn support, what I call a wall. So a whole bunch of stuff could happen here. Break down, pull back up when you hit that previous resistance turn support. Now test that support turn resistance, go back down, talk. Hey, it looks like a downtrend, guys. Lower highs. Remember, this is monthly candle chart. Takes a long time for this to materialize. And that's what I'm imagining. As long as we're making lower highs, as long as we keep making lower lows, as long as the 12-month moving average is going downwards, as long as you're below the 12-month moving average, this is just how you deconstruct the chart. And all these signs I'm looking at, when you stop making lower lows, when you start getting close to the 12-month moving average and start skewing, the incline is diminishing, less and less incline downwards. That's our other evidence that the stage 4 decline on the monthly chart is slowing down. All the criteria that Stan had in his book for the 30-week, using the weekly chart, you could apply that to the monthly chart, guys. And so before we reach that swing rule, first we have to construct that top pattern. And if you close below that 56 level, before you reach that target all the way here down to 10, there's still going to be a lot. It's not going to be a free fall. You have important support right here. You have natural support right down here. And maybe when you break through that, you get down to these levels. But swing rules help you estimate the capacity of that decline, where it goes. If I got greedy on the swing rule, well, worst case scenario is the price action is going to go down, down, down. And if it doesn't go as much as I thought, then the price action, instead of keep going down, is going to go back, close above that 12-month moving average, and I'm going to cover my shorts and say, okay, that's it. The trend's over. People are buying. That swing rule, I'm never going to get there. So it doesn't have to be absolutely a target. It gives you an indication of the potential of that stage 4 decline, guys. It's like classical chart trading framework. How they use it, measured moves, how somebody would use Fibonacci as measured moves, as Elliott wave, etc. All these techniques derive through the price action to get their targets. Usually I like it when there's harmony, when the targets there's symmetry and they coincide with close targets. I like that. So don't use just one of them. The worst case scenario is the ultra flexible stage analysis. The price action closed above that 12-month moving average. You're out of there. Oh, okay, nasty scribbles. That's a nasty, nasty chart. Lots of volatility. You see this red zone? Price action was below 30 moving average, declining 30 moving average, underperforming the SPX. Nice stage 4 right here. Close above, you're out. See, it's gray now. You're above the 30-week moving average. Uptrend. They're not lasting super long, guys. Another downtrend. But you're probably not below monthly defined breakdown line. So a lot of these trends, a lot of these what could be played as stage 4s, if you just look in a nutshell, we're going to avoid them because you don't want to get whipsawed. You want the best quality stage 4s. So unless you have the higher trend in your favor, unless you have you're below the Ichimoku cloud, the sector, the industry you're in, are they in stage 4s? All that has to add up until it's ready, guys. Don't force it. Here you see that you got ready, guys. You're below that Ichimoku cloud. We saw it on the monthly chart that you're really below that monthly defined breakdown line. All that time, you're going to have an acceleration now of the downtrend, and that's when you want to be in. Just like in the breakout stage 2, when there's a huge volume, you want to get in when that stage 1 is really done, and that stage 2 is really to accelerate upwards. Same thing for a stage 4. You want to make sure that stage 3 slowly sloping downwards, that looks like a stage 4, but I'm getting whipsawed every time I enter, and like here, these peaks above that 30-week average, you don't want that. You want a clear fall down, just like here. All right, but how do we enter here, guys? Can we enter? I think it's pretty tough on this chart. Oh, I kept all my scribbles, guys. I kept all my scribbles, sorry. So we're below the Ichimoku cloud, underperforming the SPX. Huge red volume. Damage, remember that damage I said? Ninja swords. Oh, trying to get back in the action. Another one. But now it's killing it. It's killing it even more because now you're below technical weekly defined support. It's actually right here. Below monthly defined support, actually closed December below that monthly defined support right here. Free fall right now. Bounce off, monthly defined, and after that maybe that would be crazy back. Here would be a good risk to reward entry right here. With that 30-week average going downwards, or that 12-month moving average going downwards, hitting that support, turn resistance, and then you could probably continue down for the big play. If that doesn't pull back here, well, here you're kind of far from that 30-week average. I think you just have to wait. And if it doesn't get back here, and instead of bouncing up back hard, there's two scenarios. In hard downtrends, it's not like that you have the gravity works against you. Well, it works for you because the price action goes down faster. But it's not like, let's say you're going uptrend. The gravity, price action goes up, and it's always like gravity bringing you back down. Oh, in a downtrend, the price action going back downwards. It's hard to go back up. There's so much gravity that most of the time what you're going to do is you're probably going to just a little bit more of a sideways move, stalling, and then after that, break down when you get close to that moving average. So if I could use my imagination one last time, where is my important monthly defined support? Go on the weekly. And this is what I'm going to be looking at. Price action probably going to zoom down here super fast and maybe consolidate here for a while. Maybe. And then we get a chance around here. Instead of having a chance here, pull back close to that breakdown line. I'm imagining that we're more likely going to have to wait for a little while, let that 30-week average catch up, and hope that support holds. And after that, get a good risk reward entry right here when it breaks down here from that 57 level, guys. So that's it for Exxon. Huge drop. Huge. All right, but until it completes, until we have those measure moves, keep following the trend, respect that moving average. Don't short if you're above the 12-month moving average. Don't short if you're above the 30-week average. Don't necessarily short if you're below the 30-week average. Don't necessarily short if you're below the 12-month moving average. Use that weight of evidence below the Ichimoku cloud, underperforming the SPX. Are you below weekly defined support? Are you below monthly defined support? How's the other markets, the sector, how all that's going? Check that out, and then you make the best decision, guys. All right. Thanks for listening. Ciao, guys.